Good afternoon. This is Chris Robinson Ag Marketing, with today's post-close grain and livestock comment for November 6th, Thursday. Well, a lot going on. Um, very busy day, especially in cattle, hitting all kind of technical retracements. You had a big pullback after hitting 16-month highs, 1 year highs, 16-month highs, what have you, in the grains. I want to talk real quick about this last whole rally was spurred by the move in soybeans. On the options expiration date, we were settled at 1040. Looks like, is that correct? The last day, on the 24th, we settled at 1041 and three quarters. The high of the move on this week was 1120. So, an 80-cent rally post expiration. Up until expiration, the high of the entire year had been 1075 and three quarters. So we wait until after expiration to explode from 1040, which is below the high of the year, to 1120, and then we finish here today at 1091. So 30 cents of that. We rally 80 cents and you get back 30 cents very quickly. So if you're not hedging, if you're trying to guess where the highs are and this that, if you're not just making some decisions there, you can always leave a lot of money on the table. I think the key is to good marketing is you want to try and catch the meat of the move. People get too high strung, too frustrated, pounding their chest like Tarzan because they need to sell the high. Um, I think that's probably the number one thing that keeps people from doing a better job marketing and trading is the need to squeeze everything. Used to be an expression. You don't want to be Mr. Whipple. You don't want to squeeze the Charmin. Not everybody sells the high or buys the low. That's nonsense. What you want to do is make sure that you're in position to take the meat of the move, right? But that's hard for some people to wrap their head around because some people would rather be right than catch a big chunk of the move. And you have to fight that part of your brain and the part of your personality that wants to fight that all the time. If you feel like you are not happy unless you sold the high tick, or you feel like you're not happy unless you bought the low tick, you will be continually miserable. Okay, that's all I have to say about that. So uh, the net changes for the day: D's corn down 6.5 cents at 428 and three quarters. For the life of me, I don't know why we couldn't get above the 200-day moving average at 436, 437. 436 was also the halfway back move of the entire year trading range. They tried, for about a week and a half to pop above that level. We certainly were ready to reward it with more sales if we'd gotten there. We've now slipped back lower, and the same thing can be said for March. March struggled to get above 450. 450 is halfway back of the entire year's trading range. It was a big resistance level, and we haven't completely collapsed, right? We're at 443, but still having trouble getting through that. So I hate technical trading as much as anybody else. I'd much rather trade a demand market where it's just going. But barring any big news out there changing this stuff, you see the impact that these technical levels can have on stuff. Okay, so moving ahead to jam beans, March beans, same thing. We had a really amazing rally, especially if you're storing beans, jam beans, or even March beans. I'll talk about March beans right now, but March beans ended the day down 25 cents, 24 and a half cents, 11.17 and a half, about 4 cents off the low, but traded as low as 11.13. 11.13 and a half was the low of the day. And again, what's the story there? Well, the same idea. Since the October 1st low, when we traded 1028 in that contract, we rallied to yesterday's new 16-month high, right? We had 1144. So from 1028 to 1144, over a dollar rally, a really good opportunity. So we gave back some today. I would not be surprised to see a little bit more pullback. Just that's the nature of the way these markets trade. We'll see. The thing I'd be worried about if I'm looking at March beans is, are we going to go get that gap down there? There's a gap down there at 1076. I know that sounds crazy, but it's something I would be worried about if I was long here without either a hedge or a sell stop or some protection against a flush. Because when markets can rally $1.10 in 3 weeks, they can drop very quickly in 2 or 3 days. You never know. Nobody knows. Nobody gets a special text message when it's going to happen. Again, what I'm trying to do with my clients, everybody out there, is to reward these rallies. And if you can't reward them with a sale, you reward it with a defensive hedge. It's really that simple. It's not brain surgery. Nobody's reinvented the wheel. Nobody is friends with psychic friends networks. We're just trying to take what the market gives us, make the best decisions we can. Moving on to the wheat, we finally got confirmation that China bought wheat. We had rumors of that a couple days ago, especially after they uh, bought 10 cargoes of soybeans from South America after telling us they were going to buy our beans. They did a kind of a courtesy buy. And what did the market do? Well, it was buy the rumor, sell the fact. It's out on the news wires this morning. And what do? We break 20 cents. So after a 50-cent rally, and I'm looking at December Chicago, we went from 492, a 5-year low, to a high of 555. 50 60 cent rally. And then boom, they announce it and we break 20 cents. So hopefully you took advantage of the rally, and if you're storing wheat, did something with it, either sold into it. I've got no problem selling into a 50-cent rally, 55 cent rally. That was the highest price that we've had since July. So a 3-month high. So that was a gift. Now, is it going to continue? I don't know, but it did actually give a little bit of something to do. If you're looking out ahead till next year for the July option for a hedge for next year's wheat. Again, if you're following my letter, you or if you're a client, you would have gotten an email, a text message, and everything. Me kind of tapping guys on the shoulder. That's what my job is. I can't tell you what the highs and the lows are, but when we get really, really good rallies, I try and make sure that we reward those with either sales or hedges. And my game plan is not to tell you where the exact high is or the exact low is. I think I've already said that once or twice. We're trying to catch the meat of the move, kids. Okay, let's finish up with the fat cattle and the feeder cattle. Just getting hammered technically today after we'd had a beautiful 10-month rally. We've been waiting and waiting and waiting for some sort of a sustained correction. We kind of got it here in the past 7, 8, 9 days. The low today in fat cattle, that 215 area. It's the lowest price we've had since July. So a 4-month low. And again, it's just one of those things. The market gets ahead of itself. There's worries that the borders might reopen. There's worries that if the president loses his arguments with the Supreme Court about tariffs, that would take the tariff off Brazil, and then all that Brazilian beef comes pouring back in, right, with less of a tariff. Technically, what happened? Well, if you look at Febs, and again, if you're not getting my letter, take a look at it. But I break all this stuff down in there for you. If you look at the entire big run in Feb Fats, today's low was almost halfway back. 212 would have been halfway back of the whole mess. We stopped at 215. We are well below the 38% retracement. So again, these technical levels come in right now. Today's only Wednesday. You could see a couple more days of selling. Although we have seen this before, where we make a new low, everybody gets short, and then we have a $10, $15 rally. So they're not going to make it easy for you, no matter how you cut it. If you look at feeders, I'm going to look at March feeder cattle. Finished the day down 467, but it had been traded as low as 306. Finished at 306.30. Finished at 311 even. $5 off the low. Another $11 trading range from 316.72 to 306.37. There's plenty of room there to get in trouble when it's $500 a penny and you're moving 10 pennies at a crack. But the same math kind of applies for as well. Very, very technical. What do I mean? Well, you take the contract low back in April, 7 months ago. We topped out at 378 and change. This area, this 309.5, 310 level. Why is it so significant? Well, it's the 62% retracement of the entire move. So what took 7 months in about 14 days, we've given back 62% of it. Actually, a little bit more if you look at the low. So very, very technical. Now we'll have to see, are we going to do a little backfill in here? But certainly when you go from 378 to 306, darn near $70, $68. That is a lot of revenue to give up. 68 bucks times 500 bucks a penny, and if you weren't hedged, I'm sure you wish you were. I understand nobody gets a text message saying the top's in, the top's in. But again, what we're trying to do is capture the meat of the move, not the actual highs and lows. And I'm going to finish up real quick with lean hogs. Lean hogs also have been on a tremendous rally. We bottomed out in April around 77 cents, 78 cents, right? We rallied up. We had a tremendous rally. And then this low, this correction that we've had, a 4-month low, very, very technical. If you take the low, and I'm going to do this right now as I'm talking to you, 66.90, I'm just going to call it 67 cents. That was the first tariff low. Remember when they first announced tariffs? Then we rallied up to 91.50, 91.60. This area, this 79.25, right here, we're halfway back, kids. So bullish or bearish right now, everybody's correct. What's the next downside risk I'd look at? 62% is down to 76. So we're at a point where you're going to making some decisions here. We'll see if people reload and try and catch a new rally higher. I don't know. But again, my whole program is based on helping producers. If you're a producer, you are a net long speculator. You're always bet long, period. So it makes sense that you use defensive hedges to defend that long position, right? I get it. It's kind of a weird way to look at things where you're saying, okay, I want to have this trading account with you, Chris, but I hope I lose money in it, because that's the key. If you're losing money in your hedge account, you are gaining it in the cash account. So it's a hard thing to wrap your head around. I think the people that are most disappointed and get most frustrated with marketing are people that think that I'm going to make money in the cash market and I'm going to make money in my hedge market. I'm going to double dip, do the Texas hedge. I really think if you keep things simple, you can use these options to help you make better trades, better decisions, and that's what we shoot for here. So anyhow, this is Chris Robinson, Robinson Ag Marketing. Later on tonight, I'm going to post my clients' seminar, webinar, what have you. I'm going to break this all down, kind of like a little classroom, and I'll send it to you in email. You can follow along with it, stop it, run it back. Because I'm trying to explain to people exactly what's helping us make these decisions, and also not only as to when we're doing our cash sales, things like that, but also how we choose hedges, number one, and also how we manage hedges when you have moves like this where you've got to put on that you paid a little bit for, that all of a sudden is 3, 4, 5 cents, and vice versa. Anybody that sold soybeans prior to the meeting in Korea, we suggested at the time, I'm like, hey, if you're making a sale here, and at the time we were selling into what we thought was a really good rally, a dollar rally, we're like, okay, let's take a look at this and hold back 10, 12, 15 cents of that dollar rally and re-own them on paper in case what happened, happened. So we rallied 80 cents after we thought we made really good sales. So hedging the sale after the hit sale with a call option is also always a choice. And for guys now that if you've got cattle and you're selling cattle into this 4-month low, if you're selling lean hogs into this 4-month low, you may even think, well, gee, what happens if 4 months from now we're back up on the highs? So yeah, you can always have that choice. And that's why I like using options. They give you the choice. You can decide how much you spend. You can decide how much time you have coverage for. It's a lot different than just buying it on the board and then exposing yourself to margin calls. Okay, have a great day. This is Chris. Take care.